important part about asset management is handling the unexpected things that don't show up in the underwriting. And we'll talk more about that in our specific case study, which of course, as many of us have dealt with over the last 18 months, COVID, none of us expected that. No one had that in their underwriting, but we all are here today. So we all somehow made it through. Then of course you have insurance claims related to fires and floods, et cetera. So it's all about being able to adjust on the fly and not always for bad reasons, right? Maybe, cap rates compressed crazily in the last 2 years and you did not expect that. And now you could sell and make way more than you ever thought. Well, do you, right? So there's sometimes good adjustments. And then, of course, like COVID, a more difficult adjustment. So, and then finally, we get to the sale portion, and there's not a ton to do, but there's some decisions to be made, of course, which is the actual to sell or not to sell decision. And often people are presented with the opportunity to either sell or refinance, and then kind of understanding, well, what is more beneficial from a return standpoint. But I think the overarching or the more powerful driver of the decision is really investor preference, investor sentiment. So depending on how your deal is structured, there might be a voting mechanism. There might be no voting mechanism, but either way, I think it's always good to just check the temperature of your investors and see what do they want, because maybe a sale isn't necessarily, in your opinion, the best thing to do. But if your investors want it, I really think that at the end of the day, you're serving them. So you want to present all the information and the case, but investors really drive, I think, this as a major decision, right? There's not a ton of things that investors really either have explicit or implicit control over, or just decisions that they're able to make as far as the entire life cycle of the deal. So this is one of those ones where they actually do or should have an influence. So with that being said, one component of the sale is the Xirr calculation. And so when you do actually sell a property and go full cycle, you should have to calculate your entire returns through the life of the deal. And so the proper way to do that is through an Xirr calculation. And I'll show a template spreadsheet that I have and that you can download from me for free to use on your own, which is an Xirr calculator, because these can be actually kind of tricky to calculate. And it's not something that we all think about when we're doing deals, because we're always thinking about underwriting and buying deals. We're not thinking about how to calculate the returns on the sale. And, you need to have that waterfall functionality to know where to distribute, dollars to your various investor partners and the GP promote. What else do we have here? So I think that's pretty much it. One thing I'll mention about the case study, since that's what we're talking about, just taking a step back, the case study in itself is a super valuable document that, as a sponsor, you should not overlook this by any means. It can really propel and make the most of your track record, because that question comes up, especially with more sophisticated investors, institutional investors, family offices, crowdfunding platforms. They want to know the track record, and you can make your relatively small experience look very robust if you're able to support everything you've done with a really well thought out and with the numbers case studies. So that is I would definitely not overlook that. And as well, refis are really treated as a quasi round trip. So you can get, I've actually been pleasantly surprised by how many investors I talk to, and we tell them, oh, well, we've refied a couple of deals and successfully implemented the business plan. They go, oh, okay, that counts. That works for us. So I would also, urge sponsors to take advantage of those experiences and build case studies for that as well. And then, of course, upon sale, the last note is 1031 exchange. I think that's just a really great customer service piece that you not always can, but if you can add it to your deal and offer investors that opportunity, both going into your deal and going out. There's multiple ways to do it. It's not the easiest thing to do in the world, but it is a really great customer service that can help investors out a bunch and can lead to you as a sponsor building long-term repeat relationships with your investors. So let's dive into the case study. So the deal we're talking about is called Cranbrook Forest. It's a 261 unit Class C property in Houston. And I think, what do we have here? So we've got this little page, but I've actually got the case study itself that we have, which this is the, what's going on? So this is the actual document that we provide to potential investors when they ask for more due diligence on us. So, we've had, very sophisticated family office type investors and private equity firms invest with us, and they really want to know everything. And they're asking for our org chart, case studies, references, all that stuff. So this is kind of a separate topic, but we try to keep all that stuff super organized so that at a drop of a hat, if it's requested, here we go. We've got we've got everything for you. I got one of the most feel good phone calls one time from a family office that we're closing a deal with right now. And, after he committed to our deal, he told me that, the thing that impressed him the most was, he said, I remember I called you and I asked you to impress me in 60 seconds. And you didn't hesitate. You knew exactly what to say. And you pointed me all in the right direction. Right. And all I did was, hey, listen, we have this data room with case studies just like this one that we're talking about tonight. And we've got our presentation, our track record, our references, testimonials, boom, boom, boom. And that's what, that's what really stuck in his head. So I think being organized like this, just as a general idea, is very valuable. But let's jump into the case study. So like I said, it's a 261 unit, a little bit big. So it's a 261 unit Class C property that we purchased in July of 2018. And this was what we'll call a deep value add. It was our first deal that we bought. And we really took, if we knew what we knew now about how difficult a deep value add like this would be, we probably would have been a little bit more cautious about this. But that was, take the good and the bad of being, less experienced and just more ambitious to just dive in. But we really had our hands full with this deal as we took over in about low 80% occupancy. And we quickly went down to 70% occupancy. And we were handling all of this as we were trying to implement our interior and exterior value add program to cure deferred maintenance, bring the interiors up to a higher level to command roughly 20% higher rents, and also add washer and dryers into the units. So, we felt really good about our basis. We bought the property at $59,000 per unit, and our business plan was to invest a little bit more than 1.5 million into the asset, which is slightly less than $6,000 per unit. So in retrospect, that's really not that large of a CapEx budget. But at the time, and for this level of asset, we're not talking about premium upgrades. It was a fairly substantial renovation to lift and improve this asset. And so I'll just touch on some of the numbers that you're seeing towards the top of your screen. So we had projected these numbers here. So we had projected a 5-year hold. We had projected, actually, so we made so many mistakes here. So it'll be great to show you all the things that we did wrong and what we learned or have learned since then. So what you can see here, which if you're used to seeing return numbers, this should jump out at you and say, this doesn't make any sense. So we have a 5-year hold, but only a 1.66x equity multiple. So what is that? Well, that is because of a refi. If you have a projected refi in your model, you're going to return a lot of capital early on, and then that capital is no longer going to be working for you. So your equity multiple is going to be lower. So that's what we had there. So moving forward, we don't project refis in our model, not because it's evil or anything, but just because it adds more complexity and it's a tougher story to explain to investors. It's better to make less assumptions as part of your business plan rather than more. The other thing that we did here was we had a 60-month hold or a 5-year hold, in spite of the fact that we acquired this property on a bridge loan. So these days, if we're buying a property with a bridge loan, we'll underwrite a 3-year hold period to match the term of the bridge loan, which is most often 36 months, to the hold period. That way, we don't have a mismatch in terms of business plan and loan term, because otherwise it can get messy, right? If you have a longer period than your loan term, then you pretty much have to model in a refi or an execution of your extensions, right? Many bridge loans commonly have a initial 3-year term of 3 years. I'm sorry, initial term of 3 years, and then 2 extensions for 1 year, right? For a total of 5 years. So you theoretically could hold that bridge loan for 5 years, but it's often not the most accretive thing to do because those extensions can be costly, and the bridge loan itself is costly, more costly than permanent financing, that is. So that's why today we do bridge loans on an underwritten 3-year hold, but with the idea that we will most likely sell or refi before that 3-year period is over, right? Because our loan maturity happens in 36 months. Our business plan will probably be implemented before then, and then we'll have the opportunity to sell or refi. And in that case, if we do refi, then we're holding for longer than the original 3-year plan. So that's kind of the thing that we make sure to communicate with our investors, is that if it, just because it's a 3-year hold in our underwriting doesn't mean that we might not love this asset. It manages well, cash flows well, and we want to hold it for longer. So on the actual column here, this is what we did. And the story gets deep, right? We've got COVID, but so we wanted to sell this property right before COVID. So we had it on the market, and we started having people fly in for tours and check out the deal. And then that was February 2020. And then bang, COVID hit. Nobody was getting on planes, and we actually pulled the property from the market, and we executed a refi. And it was a very timely refi, but not necessarily the best time to refi. We closed that refi in April, basically the first month of COVID. And we did that because we didn't know what was going to happen, right? COVID came, and many people thought that the world was going to end. And so we didn't want to have any bridge loans in our portfolio. And this was our only bridge loan at the time. So we did everything we could to refi as quickly as possible. And of course, at that time, right at the start of COVID, when everyone thought the world was ending, we didn't have the most confident appraisers, ascribing values. But nevertheless, we did get a reasonable refi, and it was executed 18 months into our hold period. So, and then these implied IRR calculations and return calculations are based on the appraised value of the refi. And so let me just remind myself here. 21.5. So we executed the refi at an appraised value of 21.5 million. And just fast forward to today, we have it under contract to sell for 22.1 million. So there's been some, I would say, well, there's certainly been some appreciation and normalization of pricing since that beginning of COVID. So that's why we have it under contract to sell for 22.1, in spite of the fact it being a loan assumption, which we'll get into more later. But that's where these IRR calculations are coming from. And just as a tip, if you are looking to put together a refinance case study, then this is what you should do. You should take the appraised value from the appraised value in connection with your refi, and then put a hypothetical sales cost percentage, like let's say 3% for sales costs, right? So subtract 3% from your appraised value, and then now that's your net sales proceeds, and then run that through your waterfall, and then that's how you get your returns. So diving more into the deal, what ended up happening was we were able to successfully, not without challenge, we were able to implement the business plan, which we took rents from about $750 to $850, and we're able to lease up to the low 90% occupancy. So we're able to stabilize the property, and that's what allowed us to actually refi into an agency loan right at the start of COVID. Some of the other things that we did, which were really important for this asset in particular, were we improved security. So in this particular area, crime was a factor. And so we added cameras across the site and added LED exterior lighting to really help, bring light at night to avoid illicit activity. We also have a courtesy patrol officer on site. And so kind of being proactive with those things to mitigate crime is really important. That definitely is one way to a property that has occupancy problems. It can often be a crime issue. And so where people just won't rent for any price. And so that's something that we had to really clean up right away. The other thing that we noticed, this is just a smaller idea, but we noticed that the fitness center was connected to the leasing office, and therefore the fitness center wasn't open during non-leasing office hours. So what we did is we installed another door and then made it so that when the leasing office was closed, that door was locked, but then the other door would still open to the fitness center, making it a 24-hour access fitness center. So just getting creative with the space that we have to maximize amenities. The other things we did, we added a playground, a dog park, the summer kitchen by the pool, and improved curb appeal with balloons, flowers, etc., landscaping. So here you can see the unit mix with some of the going in rents versus the achieved rents. And let's see what else we have here. So talking more about the exit, like I said, we hit the market for sale in February 2020. We were deterred from the sale via COVID, but nevertheless, once people realized that the sky wasn't falling, it actually became a great time to sell heading into 2021. And so we listed the property a few short months ago, and now we're under contract to close before the end of the year on it, subject to a loan assumption. So the loan that we did, the refi that we executed back in April 2020 was a Fannie Mae fixed rate loan. So that will have to be assumed with the sale. So the IRR with this project, right, on a refi at 21.5 million was a 26.9 net IRR, which is really crazy. I mean, that's a great number. But the crazy part is that the actual sale is now taking place, quite a bit later, call it 30 months later. And so even though that we're selling at a higher price, which is 22.1 versus 22.1 versus the appraised value of 21.5, the IRR came down substantially just because of that time. So our net IRR projected based on our price that we have under contract is going to be a 16.5% net IRR to investors. So you can see that when you're talking about these shorter timelines of 18-month hold, 22-month hold, 30-month hold, the IRR changes radically based on how quick you can get in and get out. So, it sure would have been nice to actually have sold, even at that lower price and been able to post a mid 20s IRR. That'd be amazing. But that's one of the reasons why IRR doesn't always tell the full story, because the actual difference in dollars in your pocket from that 16 to 27% IRR is not that huge, but the time plays a big factor. So I thought that was pretty interesting when I was coming back and looking at this information. So that is pretty much it with the case study. The other thing I wanted to show you, as I mentioned, was just the Xirr template. So, what I've seen even from, very sophisticated owner operators, they sometimes are left scrambling and building a one-off spreadsheet to calculate their returns for a deal upon sale. And so when I saw that, I thought, oh, wow, that's not what I want to have to do. And I don't want to have to constantly be checking for bugs and all that kind of stuff, because you're talking about calculating investor returns and distributions. And also on top of that, these days, a lot of us have investor portals where these calculations are done for you, but call me old school, but I just really trust Excel more than, an investor portal. So I always want to double check the numbers just with as simple of formulas as possible. So just looking at this XIRR real quick, and if you're not familiar with what XIRR is, it is a IRR calculation in Microsoft Excel, but with the added feature that each cash flow in the IRR calculation is tied to a date. And so that's why you see here, we have dates going as one row, and then you can input cash flows on another row. So to give you an example, right, the first cash flow could be the initial investment of, let's say, $1 million. And let's make it today. So 11/8 21. So today we invested $1 million, and then let's say January 15, 2022, we get some cash flows, a nice maybe $15,000 distribution. And let's just fast forward a couple years later, let's say January 15, 25, we actually sell the property, and let's say we do really well, so we double our money, so we get back 2 million, pretty short period of time. So you can see the gross cash flow, the IRR is a 24.8 IRR. And then we go and we actually run through a waterfall calculation. And so just to give you an idea, this is often like so. So you might have a 30% promote over an 8% hurdle. And then over the 15, you might have a 50, right? This is a pretty standard calculation. So we'll just quickly run through the waterfall, and I promise I won't bore us to death with all these numbers. But in the first tier, we're providing investors with just that 8% return, 8% IRR. And then the remaining cash flow still available to distribute is at 740,000. So that follows in the tier 2 period. And then I actually got the same thing happening in tier 1 and tier 2. So we actually have to go to tier 3 to see that the cash flows getting you to 15 are X, and then 341's remaining. So then finally, promote in tier 3 is 120, and then there's another promote at the 50% rate. So in total, I need to put in some numbers here. So let's say sponsor put in 10%, and then investor put in the rest. So here you can see the investor puts in 900,000. They got their pro rata portion of that distribution, and then they get what is based on the waterfall, their 1.5 million in distributions upon sale, which gets them an 18.9, right? So you went from the 24.8 gross to the 18.9. And then the sponsor, right? This is a little bit of a tricky or a conflating scenario where the sponsor is being compensated not just on their capital, but also on their time and effort and et cetera, via the promote, right? So if you were to put those together, the sponsor gets the same 18.9% return on their 100,000, but then you add in the promote and, they get a 62 IRR. So that's not exactly how we look at things, but, people like to see that nonetheless. So that's the quick XIRR calculation, which of course has to be performed to be able to calculate to the day, right? Because we have dates to the day, the returns based on the waterfall. So that is it. Hopefully I didn't race too quickly, but that is all I have for you guys today. So here we have some questions real quick. Can you explain the acquisition debt in the left column? Was this a loan assumption? So let's jump back to that real quick. So I believe we're talking about here. So this was a bridge loan on acquisition. So it was not a loan assumption. We acquired it with a bridge loan. We actually had a total loan amount of 14 million, but we didn't use $500,000 of the loan's proceeds. So the total funding ended up only being 13.5. So when we did the refi, we were actually able to get back some of those funds that were, essentially never funded as part of the initial loan. Russell's asking if we did a cost seg on this property. We did. We did do a cost segregation analysis, and we opted for bonus depreciation for the year one, which was very favorable. And that's all the questions that I see here so far. So would love to hear some more questions from you guys. So we got one coming in. Who was the management company in this deal? So we partnered with a company called Topaz Asset Management. So small, well, not small anymore, but a smaller management company based in Dallas. They managed our entire portfolio prior to us bringing our operations in-house. And we brought operations in-house in September of this year. So this property is currently under our own management, of course, pending the sale. Irish is asking, wouldn't a software such as IMS do the waterfall structure or waterfall calculation for you? Yes, absolutely. Any half decent investor portal is going to have certain return calculations, not as robust as you would think, but as I said before, we use an investor portal and we're transferring over to Juniper Square next year, which is supposed to be the best of the best. And they claim that they can handle any deal partnership structure that you can think of. So hopefully we won't be finding out about that because we'll just keep it simple. But like I said at the beginning, no matter what, it just feels good to just double check it with, with Excel.
I got a quick question for you, Rob. You said that, this deep of a value add was a little bit more than you anticipated going in. How does that change your approach moving forward?
Yeah. So we have, since this property, done similar or even deeper value adds, and at the same time we've also bought properties that were less work and in nicer locations. I think it changes based on the market, but what we have felt to be the case over the last couple of years is that you are often not paid for the risk that you're taking on a deal like this. Since the market is so competitive, it's competitive across the board, whether you're buying a nice new pretty deal like the deal you guys are closing on right now, or you're buying something rough like this. The returns are compressed and there's not a lot of return differentiation. So if that's the case, right, why would you spend all this extra effort and risk to really not get that much of a better return? So we do bias ourselves towards nicer deals if we can, just because that's what we're seeing is the better buy in today's market. With that being said, what we love is these types of opportunities. We can't wait for the market to be pricing this way again, where it makes more sense. I mean, you can't buy for anywhere in Houston pretty much for 59 a unit. It doesn't exist. And so that's why we're kind of shying away from the deeper value add stuff. But to our core, who we are, we love the idea of buy it, fix it, sell it, buying complexity, selling simplicity, and really making money that way. So that's how we've adjusted so far. And definitely the other thing to mention is just being more conservative and aware of the difficulty associated with a turnaround project like this, right? You can't just assume that you're going to buy it and then in year one everything's perfect and you turned all the units and raised all the occupancy, right? Things take time. You often take steps backwards before you take steps forward. So you just want to have the right assumptions and guidance to your investors about the realistic progress you can make.
Like plenty of questions are coming in now.
All right, awesome. Okay, cool. So let's see here. We've got, how does management charge? Or okay, so I'm gonna what does management charge? So a pretty standard property management fee for a property of this size is 3% of gross receipts, so 3% of collected revenue. And the responsibilities of a property management company are to staff the asset with on-site employees, oversee marketing, train those on-site employees. So hire for them, train them, HR, that whole deal. And then the marketing of things and also accounting. So accounting and reporting are another big function of property management companies. What was the name of the I'm sorry, of the software that we converted to? That's Juniper Square. They're very expensive, so there's just no reason for me to be doing a commercial for them on here, but that's who they are, Juniper Square. So was the depreciation passed on for year 2 and year 3? So yes, so there were further losses that were attributed to the year 2 K1. And so let's see, I was wondering if that would affect the investor's tax implications if we're blasting or if we're basing depreciation over 5 years. Yeah, so what, whether your initial plan is to hold for 3, 5, or 10 years, that shouldn't necessarily influence the tax benefits. If you elect bonus depreciation, then you're basically going to take all 5-year and 15-year property associated or picked out by the cost seg report. All of those 5-year and 15-year items are going to be taken as losses in year 1, right? That's why you're going to get that big bonus depreciation year 1, and then subsequent depreciation is going to be based on capital expenditures that you do and the residual straight line depreciation. So why did you decide to sell versus holding long term? So that's a great question. So yeah, we have a nice long-term loan in place, right? We did go through the refi. So the decision to sell was there's multiple. So like I mentioned at the beginning of the presentation, I think the largest factor is investors. I think it's important to kind of listen to what your investors have to say. And so our investors in this deal were, we're open and interested in a sale. For us as a sponsor, selfishly, this property will mark our first official round trip, which will do wonders for us, even though that it wasn't the returns that we had hoped for, right? We were pretty ambitious, looking for a 19% IRR, and we're only going to be hitting a 16.5. That notwithstanding, this still will be great to help us with our track record and help us, just move forward in our business. So that's really valuable to us as a sponsor. And then another selfish thing is on the management side, this deal does not run itself. It is not an easy property to run. It's in a Class C location. So I would say that if you were a 10-year holder, this would be a great opportunity. This neighborhood, this market is going to continue to improve, and you'll really reap the rewards of that. But in the short term, right, it won't be an easy, smooth ride to holding it for 10 years. It's constant effort, constant attention. And so, right, as a management company, you make 3% of revenue, whether you're in a Class A building or in a Class C building, right? So from a management standpoint, right, it's always best to just be managing as nice a product as you can. That's why, there's certain third-party companies that are just a management-only company, and they won't even manage property like this, right? Because to them, it's like, why? There's no upside for them. There's just downside and headache. So that was one of the reasons for us really wanting to be vertically integrated, is it makes it so that our property management company just only serves us as their only client, and we can make sure that our assets are getting the attention that they deserve. So we have a question about high LTV and minimal equity. Can you explain in more details? ... So this property was financed with an 80% loan to cost bridge loan, which is a standard leverage. So I would say that the equity was normal, but yeah, nothing really out of the ordinary there. As far as LTV is concerned, yes, it is a high LTV because the CapEx budget was 10% of the purchase price, right? So it made up a pretty substantial portion of the total capitalization. And that's where you can have, when you have a really big CapEx budget, you can have situations where debt even exceeds the purchase price on a loan to value basis. But lenders, generally speaking, are going to keep the total leverage in check to a maximum of about 80% loan to cost, right? Factoring in that CapEx. And just another point is lenders don't fund that full amount at closing. They'll fund 80% of the purchase price at closing and hold back the CapEx funds and then distribute those as work is completed. So we've got a question. So property management company collects rent and manages all financials. How do they submit report? and how often do you audit? So just to reiterate, well, I'll answer it in two ways, right? So and it's really the same, right? Whether it's a third-party management company or your own in-house management company, it's really the same. The property management company is collecting rents, it's managing the books, responsible for entering all of the invoices in and all the rents into whatever property management software is being used. And we produce our financial reports on a monthly basis. And so those reports are created by our management company. And then we, as an asset management team, we review those, make sure everything looks good. And that sets the basis for our monthly and quarterly reports. We actually share those straight up property management reports to our investors in our monthly reports. So it's a 200-page PDF every month with the entire general ledger and all sorts of stuff. So we don't actually do, third-party audits. So that's not something that is included in these deals. What did you or your management team keep paying occupancy during COVID? I'm not sure what that means exactly. Feel free to clarify, but I'm going to interpret it as like collections. And, collections were very lumpy, as a momentum team, I'm sure can attest to. So it was kind of like April really rough, then May bounced back, and then, June maybe okay. Right. And it was kind of based on everything that's happening in the news, right? People getting checked, people not getting checks. You can evict, you can't evict. So it was super lumpy, but I would say on average, if you average it out, it was maybe a 10% drop in collections, right? And occupancy actually stayed, and it depended on property by property, right? Some properties were impacted with occupancy going down, but the occupancy that they kept, collections were okay. Other properties stayed full and collections went way down. I think the latter is more common because what happened was nobody was really looking to move during COVID, and they were likely just, if they were in a bad situation, meaning a tenant, they would stay in their place and not pay rent and not be able to be evicted. And so that's what led physical occupancy to be high, but economic to go down. We have a question from Russell. How many times a month do you meet with your management company? And do you find yourself checking the work more rigorously on your PMs? So the way our management company is structured is we have a VP of operations that's based in Houston. And so he works with our asset management team here in New York pretty much daily. So, they're on the phone all day, every day, working on stuff. And then someone from the asset management team here in New York goes down to Houston about once a month. And, sometimes it's a scheduled trip, sometimes it's an unannounced trip just to check in and see what's going on. And I would say, as far as do we check the work more rigorously on our PMs, we don't, I'm trying to interpret the question. So we really, as far as the chain of command, we empower our VP of operations in Houston to run the show. And so he has tons of experience, lots of success. And so we let him be the one that really motivates the on-site teams, the on-site property managers, and make sure that they're trained and executing on the business plan that we want. And sometimes we have to get our hands dirty and we actually have to go to the property and spend time with the property managers on site and help with hiring decisions and things like that, or staffing decisions. But, we really want to grow the team, and that requires distributed responsibility. So Irish is asking, how many investors are in this deal and how many were in agreement to sell? So we have over 50 investors in the deal, and we have some investors that are larger than others. So I would say that how many were in agreement to sell? The majority, I would say maybe 80%. But it's not like we got every single person's vote. It was more informal and focusing on investors who have larger amounts invested. Okay. Let me know if we need to hang out a bit longer, or Dustin, we need to get going, wrap
No,
it up.
yeah, no, yeah, I think it looks like, yeah, I guess questions, lot of questions. But yeah, no, yeah, we'll go ahead and wrap it up. Oh, Brian says he has one more. Oh,
All right, here we go.
we're ready, Brian.
While we're waiting, is there anything you guys agree with, disagree with? Just any interesting takeaways?
On our side, we always focus on the area a lot, and we've got similar views to you, where if cap rates are compressed across the board, it makes a little more sense to move up the food chain. So that's kind of been our strategy as of late as well. Really kind of as a result of COVID, we just didn't see a whole lot of discounts to compensate for the risk that we thought there was in the market. And so that's kind of what led us to shift to the newer stuff, but still have a value add component as well. So definitely agree with your views there.
Yeah, it definitely makes a lot of sense. And I think the market may shift. I don't think it will always be that way, but right now you're seeing tougher deals and tougher markets, both just doing very well and rising. And if you are an owner of one or both of those things, or a bad deal in a bad market, right, you're doing really well, and you probably bought the deal at a 7 cap and never thought that it would go to a 4 cap, but it's probably there, and it's crazy. And I think it's kind of like a rubber band, where that's what's going to snap back the hardest. If we do have a situation where where valuations go down, right, the rougher stuff, meaning the lower quality deals and the lower quality markets and locations, are the ones that are going to be hurt the most. And the better quality stuff is going to, everything's going to go down, but it'll be more resilient. So I think that's, if you're looking to kind of nail down your portfolio, owning stuff right now that is more solid is better, and then selling off the stuff that you probably are doing very well with. So looks like we have maybe 2 more questions, and then I'll promise I'll wrap it up. So how did you prepare for this job, and do you have experience in single family or smaller deals? So in preparation for being a lead sponsor, we went a pretty conventional path, which was finding sponsors that were already doing deals, and then we partnered with them as a capital partner, raised a bit of money, got a seat at the table, and learned just kind of how the transaction works, how the asset management works, expectations, and things like that. And I think that's a really great way to get into the business, because it is very daunting to want to take every responsibility on it first. But that was it. We didn't, or I personally didn't have a single family background or anything like that. My family has a single family background back in Silicon Valley.
Awesome. Well, cool. I think that's all the
Yeah.
questions we got. If you don't mind just sharing, if people want to reach out and connect with you afterwards, how can they get in contact with you?
Yeah, absolutely. So you can learn more about us on our website. That's lscre.com. If you're interested, there's at the top banner of our website, there's a download link to our underwriting model, and also that XIRR model that I had shown earlier. If you want to get that, play with that with potential deal that you're looking at, or just want to have plug in some hypothetical numbers, feel free to do so. And if you want to reach out to me directly, you can do so as well. I'll just put my email in the chat, and just feel free to email me there. There's also a contact form on our website if that's an easier way for you to get in touch. So yeah, thanks everybody for being here and asking great questions and keeping this lively.
Yeah, appreciate your time, Rob. Good job, man. So cool. Well, we'll go ahead and wrap it up. Appreciate everybody being on, and yeah, have a good night. We Hayden and I are going to have networking next Monday. So love for some of you folks that maybe normally aren't on there to hop on, and we have lots of great folks on there. And have a good night. Appreciate it, everyone.
All right,
Thank
thanks,
you.
guys. Thanks,
Have a
Rob.
good night. See you
See ya.
guys. Bye.